Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, and share buttons. Well, will this trigger a global crash? I believe the answer is yes. But first, let's take a look at this right here. This is brittgillette.substack.com. In case you missed it, if you're not signed up to there, we had this article that came out just yesterday that you might want to go check out, as well as there was a video titled "This is Evil," and it's on a global scale. That was only on Substack due to concerns that maybe big tech might censor that video. So I put it over on the Substack. You can watch it there for free. There's no hindrances to watching that or reading this article, but go check those out if you get a chance. So, will this trigger a global crash? What am I talking about? Well, let's take a look at this article right here. This is from yesterday in Zero Hedge. It's titled, "Billionaire Real Estate Investor Expects 1 or 2 Bank Failures a Week." UK economist says entering a new dark age. It says billionaire Barry Sternlicht, founder, chairman, and CEO of Starwood Capital Group, has issued an ominous warning about America's regional banks, which he says will fail at a rate of 1 or 2 per week. Speaking with CNBC on Tuesday, Sternlicht says he thinks that primary real estate lenders, community and regional banks, are about to get whacked. You're going to see a regional bank fail every day, or not, every week, maybe 2 a week, he said. So he started out saying 1 a day, and he pulled back from that and settled on 2 a week. I think the point is made that he expects to see massive bank failures. He added that Fed Chair Jerome Powell's ongoing rate hikes will continue to have consequences for the real estate sector. He's got a hard task with a blunt tool, and the consequences, the real estate markets are taking it on the chin because rates rose so fast. We could have handled this, but we couldn't handle it this fast, he said. Now, what is he talking about there? Let's take a look at this chart right here. We've looked at this in the past. This is from the Federal Reserve Bank of St. Louis. We've talked about this over a year and a half ago for this exact same reason that he talks about in this article. This is the Fed funds rate. So when you hear in the news, well, the Federal Reserve is going to raise interest rates, this is what they're talking about, the federal funds effective rate. And as you can see, that went from pretty close to 0 a little over 2 years ago to 5.33% as of late last year. Now, you may look at that and say, well, what's the big deal? Look back here. In 1981, it was 19%. So why would 5.3% be such a big deal? But the reason, as he just stated, was they hiked so fast. The fastest in history, the biggest percentage increases in interest rates in history. So if we look at this exact same chart of the Fed funds effective rate, but we look at the year-over-year percentage change, we get this chart right here. Now, as you can see, at the peak, this was over 5,600% year-over-year change in the Fed funds effective rate. So this was a dramatic change. Now, this went down because the year-over-year changes weren't as large after that first year. But this is unprecedented. We don't see anything remotely like this. I think the previous record was in the 1950s at, what was it? 360% in May 1959 versus 5,600%. Guys, this was a dramatic change in interest rates, and that will have a dramatic ripple effect change through the economy when those kick in, because as we stated at that time, it takes 12 to 18 months for these rate changes to work their way through the economy. And this is why he says the 1.9 trillion of real estate loans, that's a fragile animal right now. So keep in mind there's a large percentage, it's almost $1 trillion worth of commercial real estate loans mature this year, and they have to be rolled back over at new rates. Now, we've talked in the past, 87% of those loans are interest-only loans. Now, you would think we would have learned from the great financial crisis, but we have not. Those loans typically operate on a 5-year term, and the hope is, well, at the end of the 5 years, you roll that loan back over, but interest rates are dramatically higher now, and those commercial real estate properties have 50% of the vacancy rates that they used to have. Like nobody's going to the offices anymore. Nobody's going into the cities. So that's going to hit the banks hard. This article goes on, though. It says, as Schiff Gold notes, the Fed must cut rates to avoid a banking crisis. It says most at-risk firms are smaller banks representing assets under $10 billion, with a handful of larger regional ones. Some might be able to avoid closing by halting expansion plans or offering fewer services. Others might save themselves by merging with larger banks. But with inflation too high for the Fed to cut now, higher for longer interest rate policy is looking increasingly likely. And banks with high exposure to troubled commercial real estate are at particular risk of starting a domino effect of small collapses that lead to bigger ones and bleed into becoming a real estate crisis. In all its hubris, the Fed is stuck between preventing a banking crisis and preventing inflation from getting even more out of control. It needs higher rates to reduce inflation, but crucial sectors of the economy that are heavily dependent on lending can't survive in a higher rate environment, even if they don't appear insolvent at first glance. There are more than 4,000 regional and community banks throughout the United States. However, just one, Republic First Bank, has shuttered since the start of 2024 after FDIC seized $4 billion in deposits and $6 billion in assets last month. And guys, if you remember when that happened, what day of the week was it? It was a Friday. Remember, listen to what these people are telling you. We've covered before, the FDIC had that war game that they put together back in late 2022, and they talked about preferably on a Friday we do this, and we really need to figure out who we need to be transparent to, how transparent we want to be with them, what we need to be transparent about, right? Meaning that's code speak. It's politically correct language for saying we need to lie to people, and we need to convince them that everything's fine, even though, well, you and I know it ain't fine, but we need to tell your average Joe that it's fine and have them believe it, right? And then, once we can't stop it any longer and the banks fail, well, on a Friday, we'll announce that information. So guys, it's going to be on a Friday that eventually we're going to have a massive banking crisis, a bank holiday emerge. I don't know when that's going to be, but guys, it is coming. The data is there. And I know that I've been beating this drum, but it has not gone away. If the data changes, I will change my mind, but it has not. Let's read on. It says, meanwhile, UK fund manager, former MEP, and previously Nigel Farage's economic spokesman, Godfrey Bloom, has issued a similar warning to Steinlicht, telling former UK parliamentary candidate Jim Ferguson on his podcast that the banks are insolvent. We are entering a dark new age, says Bloom, who recommends that people take your money out of the banks. And I'll put a link to this at the top of the comments so you can go watch this whole program. It's almost an hour long. And you can see if you agree with what he's saying. I don't know that you need to take your money out of the banks, but I would be following biblical advice from Ecclesiastes 11, verse 2, that recommends we diversify because we don't know what risks are coming. So we should probably have some money outside of the bank, some money in different banks, depending on what you have. Everybody's situation is different. You want to be as resilient as possible. But guys, bank failures are coming, no doubt about it. Let's take a look at this right here. This is from the Federal Reserve Bank of St. Louis. This is the Bank Term Funding Program that we've talked about before. So this did not exist until March 2023, when we had the banking crisis emerge and we saw the second, third, and fourth largest bank failures in U.S. history. The Federal Reserve set up this special program, and it very quickly got tapped in a matter of weeks for $79 billion by troubled banks. They had 1 year to pay this back. I don't know how this math works because they should have paid down a lot more of this. It makes me believe some of these were, quote, paid back and then the money was reborrowed before the March 11th deadline arrived. But as of March 11th, this program is closed and this is being paid back down. So it hit a peak right around the closure. So March 11th was the last time frame. The reporting day was March 13th. But the peak was $167.4 billion borrowed by troubled banks. That's been paid down. About a third of that has been paid down at this point, and the balance sits at $112 billion. So as banks are forced to pay these loans back, it puts more stress on those banks that are already stressed to the limit. What do I mean by that? Let's take a look at this chart again. This is from the FDIC itself. So this shows unrealized gains and losses on investment securities, so bonds that these banks purchased. And when interest rates shot up, just as we saw here, when this happened, there's an inverse correlation between those securities. When the interest rates go up, the prices go down. Likewise, when the interest rate goes down, the price goes up. So when the interest rates have spiked, it's caused the prices of all of these assets that the banks are sitting on to decline in value. So since they have yet to sell these, they're called unrealized losses. But I want you to take a look at the left side of this chart here. You'll notice 2008, 2009, this would be the great financial crisis. That was the level of unrealized losses sitting on bank balance sheets back then versus now. Hundreds of billions of dollars, and this is as of the fourth quarter of 2023. Interest rates are higher now than they were in that fourth quarter, so these losses are higher at this point, and especially when you figure the bank term funding program has ended. So guys, the banks remain under stress. I can't stress that enough. Let's take a look at this article right here. This is from MoneyWise. It says a crisis is about to happen. $929 billion in commercial real estate debt is about to come due. Will America's regional banks survive the storm? So this is what we were just talking about. All of these loans come due this year. They have to be rolled back over. So people had these buildings in, say, a downtown urban environment 5 years ago when they took out the loan, or 7 years ago, whatever it may be. Those office buildings were filled with people commuting to work and working in that building. Now about half of those people are working from home. We know that because there's card tracking data where people scan into their office buildings, and we see that that's going in most urban areas at around 50% of the rate it was pre-pandemic. So that tells us that a lot of these companies have simply allowed their leases to expire and they've moved on. They've consolidated their space. Some have moved out altogether. So now we're seeing much larger percentages of office vacancy rates. Some buildings are completely empty, and buildings that once sold for hundreds of millions of dollars are now worth $2, $3, $4 million, or even less in some cases. And so who holds that loss? Well, in some cases, it's the firm that bought that property, took the loan out on that property. But in many cases, it's the banks that are left holding that debt, and it's defaulted on, and they can't recoup that loss, and it's going to take those banks under. So let's read on this. It says, entrepreneur Tom Ellsworth believes a crisis is about to happen in the U.S. banking system, and there are two competing issues battering the foundation. 1/5, or $929 billion of the $4.7 trillion of outstanding commercial mortgages held by U.S. lenders and investors will come due in 2024. He says, this spells trouble for America's small and medium-sized commercial banks and private mortgage lenders feeling the strain of America's high interest rate environment. And again, it's not a historically high interest rate environment, but the rate of change has been dramatic. He says the Fed just said the rates will be higher longer. Ellsworth said on a recent episode of the PBD podcast. There's going to be bank failures, and there's going to be commercial real estate that goes into receivership. Is he right that the U.S. banking system and commercial real estate sector is teetering on the brink? It says banks are stressed as the high interest rate environment prevails. There's concern that some small lenders and regional banks will dip below their minimum capital requirements set by the Federal Reserve. Small lenders and banks, those with less than $10 billion in assets, are stressed, but not necessarily close to insolvent. Brian Graham, co-founder and partner at consulting firm Claros Group, told CNBC. While Claros Group recently reported that 282 of 4,000 U.S. banks are facing challenges around the double threat of maturing commercial real estate loans and losses resulting from higher interest rates, Graham doesn't foresee a repeat of 2023, which saw the catastrophic failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. And I would note that the experts never foresee any of this stuff. And we'll talk about why in a second, but I think it's interesting if you follow this link for catastrophic failures, it takes you back to this article from a year ago where it says, Silicon Valley Bank's grade A rating from Moody's right before its collapse brings back nightmares of 2008. So right into the time that this bank collapsed, Moody's gave it a grade A rating. So what were they doing? They were saying, just like this guy is, I don't foresee anything like that happening. It's nothing like that could happen. And guys, let me tell you, there are many reasons that these experts never predict this. One is, so this guy, he's a consultant at this Claros Group. Many people in these types of industries, if you go out on a limb and you say something, even if you think it's going to happen, you think you're 100% sure, wow, this is going to happen, but you go out on a limb and you say it's going to happen and it doesn't, well, then your credibility is shot, right? But if you say everything's going to be fine and everybody else is saying that too, and it isn't fine, well, that's okay, right? Because who could have foreseen it? Everybody said it would be fine, right? So there's this strength within these industries of staying with the crowd, being with the crowd, not straying too far from what the consensus view is. But guys, that doesn't give us any sort of reality. And it's the same with these ratings agencies like Moody's. So if Moody's comes out and says, well, Silicon Valley, we're going to downgrade them to a B or D or E rating, well, then Silicon Valley Bank is going to say, we're not going to do business with Moody's. We're not going to give them any of the information that they want. And Moody's looks at it and says, okay, well, that hurts us. That doesn't give us the access we want. Everybody else says it's grade A, so if it turns out it's not, we'll just say, who saw it coming? We all thought it was grade A, and then it turns out it wasn't. Who would have thought, right? So there's this groupthink mentality where no one will stray outside of these lines to say, well, the emperor has no clothes. And guys, that's exactly what is going on here, because they talk about these capital requirements, and what did he say? There's concern that some of these small lenders and regional banks will dip below their minimum capital requirements. Well, guys, they already have. They did that a long time ago, because when we look at these unrealized losses, the Fed changed the rules back during the Great Financial Crisis to protect the banks and to protect these financial institutions. So they carry these assets not at their true market value, but at their face value on their balance sheet. To do that is called mark-to-market accounting, and those rules were suspended during the Great Financial Crisis. So it's basically these banks can lie, and they can say, oh yeah, we got, $10 million in securities. If they went to sell them, they might be worth $6. And so that's an unrealized loss until you have to sell it, which is exactly what Silicon Valley Bank had to do. When the depositors showed up and said, give us our cash, the only way they could do that was to sell these securities. And then these unrealized gains then became realized gains. Or realized losses. I'm sorry, these unrealized losses became realized losses when they did that, and the bank went under. So when they're talking here about, we're concerned they might go below the minimum capital requirements, I assure you, far more than 282 of the 4,000 banks, if they truly marked to market the assets on their balance sheet, probably half of them would be insolvent right now. They would not meet the minimum capital requirements. But because the Federal Reserve and the U.S. government are allowing these different accounting rules to be looked upon, be used, they can have a different truth, right? We won't call it a lie. It's just a different point of view, a different way of looking at them. Sure, you look at this and see, wow, your liabilities are more than your assets. But if we take these assets that are worth X amount of dollars and we say that they're really worth 2 times that, well, now our assets are more than our liabilities. Isn't it amazing, right? So it's called legalized lying. That's what they're doing. So guys, the banks are in bigger trouble than they say they are, and this could emerge very quickly. I know it's quiet right now. There's not a lot of talk about this, but all of this could emerge very quickly, because it's not just commercial real estate. It's not just the interest rates rising on these investment securities that the banks hold, but we also see things like this. So this is from S&P. It says, Consumer Checkup U.S. bank auto loan delinquencies reached decade-long high in 2023. It says U.S. banks auto loan delinquency ratio reached its highest level of any year in the last decade during 2023, even as wage growth and unemployment signaled overall consumer health. The auto loan delinquency ratio at U.S. banks stood at 3.32% at the end of last year, marking the highest ratio for the industry since at least 2013. The increase came even as the industry's total auto loans declined to $530 billion from $548 billion, the first year-over-year drop since 2013. So here they're saying, well, there's overall consumer health because unemployment's low and wages are growing. But they don't point out, well, yeah, you might have gotten a 3% raise, but the price of everything went up 10%. That's not really wage growth, right? You're able to buy fewer things, and that puts strain on these consumers, which is why you're seeing less auto loans taken out. And again, we're seeing all of the strain among paying mortgages, paying credit cards, paying auto loans, servicing commercial real estate. All of these things are happening against the backdrop of what is historically considered a low unemployment rate. So this is from the U.S. Bureau of Labor Statistics. It currently has our unemployment rate at 3.9%. You can see, going back 20 years, that's in the low category. I mean, that's the lowest, 2019, a little bit of 2023. There's maybe a couple of years out of the last 20 where it was lower than it is right now. I would ask, what would happen? What do you think might happen if the unemployment rate goes up the way it did in the Great Financial Crisis, the way it did in the COVID crisis? What would happen to these auto loan delinquencies? What would happen to mortgage delinquencies? What would happen to these banks in that event? And so I believe we're looking at the trigger for a global crash, because this isn't just a U.S. problem. This is a global banking problem. And again, it could emerge very quickly. And when it does, well, what will that look like? I think this chart, or at least this tweet containing this chart, gives us a pretty good idea. This says crash alert, 1987 versus 2024. I'm trying to unsee it. 1987 crash was biblical. Today we see the same setup. The only difference today, a bigger bubble. And then they have this chart, you can enlarge it here, that shows the lead up to the 1987 crash and the lead up in 2024, where we stand right now, where we had this top in the market, then we have this upward move, so we would expect the market to go up a bit, but it could very well follow the same pattern. It doesn't have to, but I believe based on all the things we're seeing, we're set up for a plunge of this magnitude. Now, 1987, in that crash, we saw it was a 22.6% drop in the Dow Jones Industrial Average in a single day. So that's what we see right here. That was the largest drop in a single day in the history of the U.S. stock market. Now, could we see something similar? We could see something similar. We won't see a one-day drop of that magnitude again, because they since put in these things called circuit breakers. So when you have a drop of 7%, the market stops trading for, I believe, 15 minutes. If you have a drop of 13%, it stops for another 15 minutes. Once you hit 20, trading shuts down for the day. So the biggest drop we could see in a single day would be 20%. And guys, I think we're heading for a crash of this magnitude, because we have so many problems within the banking system, so many problems within the economy. Almost all of these problems are related to indebtedness. People who are up to their eyeballs in debt, municipalities and governments up to their eyeballs in debt. None of this debt can be paid back, and what won't be paid back, or what can't be paid back, won't be paid back. We've talked about the Ponzi scheme that our current monetary system is. It requires constant growth in debt in order to stop from imploding. So if you missed that video, it was a week or two ago on the Ponzi scheme of biblical proportions. Watch that to make sure you understand the nature of our monetary system. It is a Ponzi scheme. That's why we keep seeing the debt go up. That's why we keep seeing debt loads for people going up. It's because it requires ever-increasing amounts of debt to continue going forward. The moment that stops, the whole house of cards falls apart. And that's what I would say we're looking at. We are looking at an epic global crash that is coming at some point. I don't know what day this is going to happen. I thought we would see the banking crisis emerge by now. But again, that could change very quickly on any given day. It doesn't matter until it does. And the world is set up to see this massive crash because of the unimaginable debt levels that have been taken on in the world, debt that can't possibly be paid back. When that debt gets defaulted on, we end up in a deflationary spiral, just as we saw during the Great Depression. I believe the response to that is going to be to print currency and hand it out left and right. So it won't last as long as the Great Depression. And it may very well end in some sort of hyperinflation. But guys, this is going to be a massive crisis. Why does this matter to Bible prophecy? Well, it matters because we've already seen what they're planning to do. They want to roll out central bank digital currency. They want to surveil every transaction. They want to have control over every person on the planet. But in order to implement a system like that, well, in order to build back better, right, you have to tear down what already exists. And they know this system is coming to an end. They want this new system to replace it. So that's what they're getting prepared for, to roll out in the aftermath of this massive crash and crisis that will come. When it does, I don't know. Maybe it's a year from now. I don't know. Maybe it's tomorrow. I don't know. But again, the fundamentals have not changed. The data has not changed. I know that I've been beating this drum for quite some time. Most people expect, okay, why hasn't it happened by now, right? But when you look back in time, people were doing the same thing leading up to the great financial crisis. It takes time for these things to work their way through the system. But guys, it's coming. Be prepared. Make sure that you have a deep pantry. Fill up your gas tank every Friday, because again, they've told us, as we saw with this recent bank failure, it's coming on a Friday. When they're shutting down the whole system, that'll come on a Friday. They won't just simply announce to everybody, oh, next week we're going to shut down the banking system, right up until the second they shut it down. They'll say, everything's fine. The fundamentals of the economy are sound. The banking system is sound and resilient. That's what they're going to tell you. That's what they have to tell you. But that's what they're going to tell you. We already have seen the film of them saying that's what they're going to tell you. That's what they've decided they need to be transparent about, at least to you, right? The insiders, they'll feed the real truth, but they'll tell us, everything's wonderful, everything's fine, until they go, oh, we were wrong, it's all shut down, but you can't touch anything right now. Your money's frozen for 2 weeks while we sort this out. And while we make sure that the politically connected, they're taken care of. So guys, make sure that you're ready for this. Guys, all of this, I think, is setting the stage for the rollout of central bank digital currency and eventually the Mark of the Beast system. So let me know what you think. Leave your comments below. Make sure to hit the like, share, and subscribe buttons. God willing, I will see you on Monday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.